Hi, I'm Peter Andresen with Andresen Associates, and the year continues to run down. 2023 has been an exciting time. It seems as though we're going to have a soft landing, and the prospect of a recession is very much not something we're talking about today. But I do want to talk about something very interesting that's happened without a lot of people commenting on it, and yet it has incredible implications. And that is what's happened in the long Treasury market. Ben Carlson, in his extremely good blog, A Wealth of Common Sense, has written a couple of articles about this. I'll put those in the links in the comment section of this video. But the bottom line is this: the long bond market, specifically the long Treasury market, that's Treasury bonds with a maturity of over 20 years, has gotten shellacked. At the moment, it's looking like in the last couple of years, there's been a 40% decline. Wrap your brain around that. That is 40 cents out of every dollar, if you had long treasuries, is gone. That equates to pretty much a negative, or just a nothing return, if not negative return, for the past decade in long treasuries. We at Andresen Associates didn't really participate in that for reasons that I'll discuss as we go along here. We took some losses in the bond market, but nothing remotely like that. But it's worth considering how this could have happened and what it means. Now, let's discuss what a bond is. A bond is essentially an IOU. That means that an entity like the United States government issues a bond, they borrow money, and they give you an IOU. And they promise that they're going to pay a fixed rate of interest for the amount of time that that IOU is outstanding. That's for most bonds. There are all kinds of different bonds. There's convertible bonds, there's adjustable rate interest bonds, but for the most part, bonds are fixed rate. And what that means is that the maturity, that means the amount of time that the bond is out there, affects the market value of the bond. If interest, think about it, if you have a fixed coupon, you have a 5% interest rate on a $100,000 bond, that means that you get $5,000 a year, usually divided into 6 months increments, $5,000. Now, if interest rates go up, what that means is that the resale value of that bond goes down, right? Because you can get a higher interest rate somewhere else. The bond value has to contract until that coupon, that $5,000, is 6% or 7% or whatever the interest rate is. Likewise, if interest rates go down, the bond value will go up. So, what happened? If you've been my client for a while, you'll remember this. What happened in the last 8 years or so as bonds were soaring because interest rates were declining, I started moving us to short-term bonds. The reason is that interest rate risk is less, obviously, in a very short-term bond because you don't have to hold it as long, or you don't have to resell it to get your money back. And it's exaggerated that interest rate risk is greater in longer term bonds. I might add, you also face credit risk in most bonds, the risk that the bond issuer won't be able to pay the money back. But with Treasury bonds, that's essentially negligible. So the only risk facing a Treasury bond holder is essentially interest rate risk. But as that went to zero, and internationally it went negative, if you remember, I've been jumping up and down and discussing this, I became very concerned about rising interest rates. This was not because I had a crystal ball. It was not because I could make predictions. It was because when an interest rate goes to zero in history, which is very, very rare, it tends to be followed by either inflation or simply gradual rising rates or a depression, which we didn't have. So my concern was that something was wrong, and I wrote about the biggest bubble of all, you might recall that. And I shortened our maturities and thus reduced our risk. Now, At the time, it's worth remembering that a lot of the talking heads and a lot of the experts were saying that lower interest rates were here forever, that inflation was dead. There were articles that I can dig up, or you can dig up if you Google it, that inflation will never come back, that interest rates can stay at zero forever. Among them were some people who are now in the government, even in the Fed. And so interest rates went down, and internationally, as I pointed out, they even went negative, which is interesting, which means that those bonds are taking 50% or 60% hits right now. And then inflation came back, and finally we had those rising rates, rising interest rates, and the bonds dropped like rocks. That meant that our shorter term bonds suffered losses. We did have losses in our portfolios, but nothing close to the 40% carnage that happened in long treasuries. Now, in the next video, I'll discuss what that means for us in terms of investment opportunities. But in the short run, the lesson here, just for this week, something to contemplate is that the implications of this are that what is most likely to happen is probably what's going to happen, at least in terms of history, despite what people say. An overvalued stock market is likely to correct. That doesn't mean it will, it just means that it's likely. An abusive person is likely to continue to be abusive. There are exceptions, but mostly abusive people tend to be abusive. Deceivers tend to keep deceiving. Good people tend to keep doing good things. History can tell us what is most likely. It can't tell us what will happen, but it can tell us what is most likely. So here we are looking at a gigantic hit in the bond market, a tremendous bear market in the bond market. You don't read too much about it, do you? You don't hear too much about it. All sorts of implications. I'll get into that in the next video. Meanwhile, enjoy our approach to the fall, and blessings.